Well, let me turn to financial markets. We've seen some volatility, especially stock market volatility. I mean, the levels of the VIX are up to the levels they were in the early days of the pandemic, coming off somewhat now. Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. So what I think is going on in markets is markets are processing what's going on. And it's really the policies, particularly the trade policy. And really the question is, where's that going to come in? Where's that going to land? And we don't know that yet. And until we know that, you can't really make informed assessments that would still be highly uncertain. Once you know what the policies are, it'll still be highly uncertain what the economic effects will be. So markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning. Conditional on being in such a challenging situation, markets are doing what they're supposed to do. They're orderly, and they're functioning just about as you would expect them to function.
So we've seen volatility also in the bond market. And at a time when usually there's a flight to safety, we saw yields on the German Bund and the Japanese government bond come down, but we saw yields on US treasuries go up. What do you attribute this to?
So I would just say the same thing. I think it's very hard to know in real time. I've had a lot of experience with significant moves, for example, in the bond market, where there's a narrative that people land on, and then 2 months later you look back and go, that was completely wrong. So I think it's very premature to say exactly what's going on. Clearly, there's some delevering going on among hedge funds in levered trades and things like that. It's also, again, it's the markets processing historically unique developments, and with great uncertainty. And I think you'll probably see continued volatility. But I wouldn't try to be definitive about exactly what's causing that. I would just say markets are orderly and they're functioning kind of as you would expect them to in this time of high uncertainty.
So the Fed in its last meeting slowed the pace of shrinking of its balance sheet. Was this driven by uncertainty about how much reserves and liquidity the market needed, and you wanted to take a little more time to find that out? And flip side, you said the market was orderly. What if market disruptions emerge? Would the Fed intervene?
So we think that reserves are still abundant. So we don't think we're close to the point, particularly close to the point where we would stop. But we were facing a situation in which, for other reasons, there were going to be big flows into and out of reserves as it had to do with the debt ceiling and the Treasury General Account. For those of you who are Treasury market people, that'll make sense. But while those big flows are happening for over a period of 6 months, we would actually be shielded from being able to see evidence that we were or were not getting close to the level of less abundant reserves. And so we decided to slow the pace. We thought about pausing, and instead we debated it. It's one of these great debates that we have at the FOMC. We decided to slow the pace instead. And people really came to see the merits of that because, the slower we go, the less, the smaller the balance sheet can get without disruptions. And we want that process to continue, and now it's at quite a slow pace. So we think that's a really good thing. So that means it can go on for a longer amount of time, and we'll be able to reach kind of very carefully what we think is the right level of reserves. Still plenty of reserves.
What about the international dollar-based system? With all these disruptions, do you stand ready to supply dollars to central banks as you've done in the past when there's been a global shortage of dollars?
Sure, absolutely we do. Just for everyone's knowledge, we have standing dollar swap lines with 5 large central banks, and they go to the jurisdictions where there are big overseas dollar funding markets. And in effect, those are overseas markets where, for example, a European or Asian institution is buying an asset-backed security that is backed by loans to American consumers. So in effect, these are loans to American consumers, and we support that. We want to make sure that dollars are available. They need dollar funding to hold those dollar assets. So the way it works is, when needed, we lend to the central bank in dollars, and they pay us back in dollars. They then pay in their currency. They lend on in dollars, and so we take no credit risk or anything like that. And it supports dollar funding markets. Dollar funding markets are very sensitive during times of crisis, and it's very helpful. The reason we do it is it's really good for U.S. Consumers. So we'll continue to do that, just as part of the dollar being a reserve currency, the reserve currency, most important, and we will do that.